Hello and welcome, and it's finally Friday. It's been a week, I would say, from hell, but that would be wrong. It's been a very, very exciting, volatile week, also significant. While everything was happening here, you also had in overnight Qs, ECB going ahead and cutting rates. So lots of moving parts this morning, but the markets will remain range bound, hopefully.
Yeah, a week of epic proportions, right? So, almost as if people say sometimes you travel through months in days or weeks, and sometimes the other way around. This week seemed like multiple months rolled into it. But yeah, at the end of it, I think there was equal measure enough for bulls and bears both. And we've kind of stayed steady because last Friday we closed circa 22,500, 600. We are circa those levels currently, ahead of the big RBI policy as well, which may not turn out to be that big, so it remains to be seen. But yep, interesting week for sure.
Yeah, it's been a good week, and I think most traders and I guess investors alike are grateful that Friday is finally here. It's been exciting. The investors have gone out and bought lock, stock and barrel in the weakness. Traders potentially could have lost some money. But then again, that's the way of the world. That's the implied Nifty this morning. Third straight day of a positive start is what we're expecting. No runaway gains, and let's be realistic about this one because you've already clawed back quite a bit over the last two trading days. This morning should be stable. The big event is the RBI, which is expected largely to be a non-event. Global cues before I hand it over to Niraj for everything that we need to gear up for in early trade this morning. What sectors, what stocks should be on our radar. In terms of global setup, the big headline is ECB, as expected, went out and cut interest rates for the very first time in 4 years. Remember, in over 2 decades, this is the very first time ECB has cut interest rates without a catastrophic event. And I think that's what you want to take note of. They've also said that they will be going from data to data, not indicating that there could be an extensive cycle of rate cutting that the markets could be anticipating. Some believe and called it a hawkish rate cut from the ECB. Guess what the reaction to that was? European equity markets did quite well. Surprisingly, bond yields actually went up across Spain, Germany, which was an interesting move after the rate cut coming in from the ECB. Well, all eyes will now shift to the Federal Reserve. 70% of Fed futures indicate that there is no rate cut expected until September. So even though the ECB has moved, Fed funds are pointing to a rate cut in September. One important data point that the street will be watching out for is going to be non-farm payroll data that's expected later on today when Wall Street opens up to trade. Ahead of that, what we saw on Wall Street was a range-bound trading day. The S&P did make a record intraday high, but finally went home slightly lower. The Dow and the Nasdaq not doing very much either in the session. Apart from that, you had bond yields that have been declining very sharply on Wall Street, actually stabilizing. They went up marginally, 14 bips to say the least. Crude, on the other hand, gained after a big fall this week. Most believe that they could have been seeing, or a bottom could be being made in crude prices. The reason we saw that is because after the ECB rate cut, expectation now moves to the Fed moving on rates. Of course, with lower rates, you expect the dollar to weaken, which is usually a positive for commodities, and also expectation that lower rates could fuel up demand in terms of crude. You also had OPEC and Russia reiterating that they will be very, very frugal in terms of production, and they shouldn't be they would, of course, move and cut production if need be to support crude prices. So those are the two factors that have helped crude. It was up about 2%, finally settling about 1% higher in overnight trade. Apart from that, if you look at what's happening in other parts of the market, gold and silver also eased off just a little bit. And from what I hear, Niraj, this is so interesting, right? The big positive for Wall Street is a weaker economy. It is almost as if the real economy is not doing well, financial markets will do well because then you're going to get a potential rate cut. And apparently, and this is the very first time, and again in 2 or 3 decades, where U.S. markets or U.S. individuals, population rather, is going through something called COLA, which is cost-adjusted inflation lifestyle. They are not used to inflationary pressure, so living through that is almost historic for those markets or those for Americans at this stage.
Yeah, because you're right, they've just never been through that. So in some sense, it's been last 2 years which have been just completely different, I think, than what they've ever been used to. And yeah, Samina is right. I mean, it just brings to forth what central banking action could mean for markets. And don't look at the Nasdaq when you're thinking of that, because that is an Nvidia story which is completely different. By the way, Samina, I saw, just before I get to the trade setup, I read something on X, which, I mean, it's just put things into context, but it blew my mind in some sense. I mean, the person worded it well. That Nvidia has added, and let me finish. So Nvidia has added $1 trillion in 32 days, which is 6 weeks. Yeah. Which means Nvidia has added the market cap of Berkshire Hathaway in 6 weeks, and Warren Buffett took 6 decades to build out Berkshire Hathaway. It just shows when something is catching the imagination, what kind of frenzy can get built into it.
But you know, Niraj, I don't mean to be throwing in the blanket here, but do you not feel like this Nvidia rally could be topping up? There are analysts talking about spotting other AI opportunities now in the market. And while it's been great, and no one ever has been able to call a stock or a market stop, but it does seem like the euphoria, if the valuations do catch up, you may see potentially other AI plays that may start drawing traction. But yes, like you said, $1 trillion is a big deal, and there are reports that one of the only problems Nvidia has at this stage is that the competitors are catching up fast. So it'll be interesting to see how that plays out. But it's created wealth, and everyone's richer and happier.
Yeah, I mean, when Apple crossed 2 trillion, everybody said 3 trillion is a far cry. Apple did that. Nvidia has done 3 trillion. Everybody's now talking about how it could be topping. Who knows? I mean, Nvidia could be at 4 trillion in a matter of a few weeks. But just very quickly, the trade setup before we get to specific stocks, and then get in a very special guest for the policy. So the trade setup for the day, I mean, most people are saying that yesterday's high of 22,910, which is where the market reversed from, kind of becomes a key hurdle. But very likely that gains are more imminent than losses for equity markets. So that's the first thing to keep in mind. Yesterday, the Citigroup team alerted us to this very interesting fact that their analysis and their conversations suggest that EM funds are largely underweight India at this point of time. They are not overweight, a shade underweight. Therefore, the long positioning on India isn't quite massive, which might actually work in India's favor, because at some point of time when funds do come back, whether they come back via the EM generic route or specific India route, might be positive. Again, very unlikely that the RBI policy can have a big push for BFSI, but like I said, we'll leave that conversation for a bit later on, because it's best to talk the policy with an expert. Just one thing though, rather two things. One, the PSU bounce back yesterday shows the difficulty in ruling out a PSU up move. Everybody said on Tuesday and Wednesday that PSUs are now a different kettle of fish and they will not bounce back. Yesterday, the market just proved everybody wrong. And just very difficult to pencil in these moves. And just look at the kind of gains that came into some of the stocks and the kind of long build-up that we're seeing in some of the stocks. I mean, a Biocon, BHEL, HAL and REC from the PSU side, but Exide. And there is some talk about how some Chinese battery makers have been prohibited from supplying to US car companies. Does that bring the India car and battery companies into focus? Who knows? Because Exide had a big move yesterday and a fair degree of long build-up as well, Samina. 12.5% OI build-up. That plus some of the healthcare names like Metropolis, Laurus, some significant OI build-up. So some interesting stocks to watch out for today.
Yeah, they will be interesting to say the least. But I think, Niraj, we cannot, while of course what we saw on Monday, Tuesday, Wednesday has been fairly challenging. I think going ahead, at least for the June series, it's going to be a slow grind. So we will have days of up move. It may not be sharp in that sense, but it'll be 2-3 days of gains followed by 2-3 days of some weakness, consolidation. Max OI remains at 23,000. So while the bias is on the upside, a lot of the gains potentially could get capped at 23,000. It's a stark difference from what we were talking about a few weeks ago when 24,000 was seeming like a likely stop for the Nifty, or that's the index, of course. On the downside, though, the trading support stands at 22,800 and 22,500, pardon me, which is where we've seen maximum put OI. The other interesting part, Niraj, is that we've heard FIs complain that India is an expensive market. I know I have been ranting on about how China is giving us a little bit of a fight. Some may argue otherwise. But despite a 6.5% correction on Tuesday, with the fact that stability has returned back in terms of politics and policy, FIs aren't coming back. Even yesterday, the sell number was rather significant. Over 6,000 crores sold. DIs, of course, keep supporting the market, and that's a great thing. That's not going to go anywhere because we do have a base and the weekly SIPs keep building up to that. But the fact remains, maybe it's time we stop waiting for them to come back and even stop addressing and talking about them because they are turning out to be rather insignificant.
Yeah, from an action perspective, yes, but you know, Samina, you're so right. In 3 days to sell off nearly $3 billion, that's a serious sum of money being pulled
unless
out.
What I think is with the JPM inclusion, which of course Lakshmi will be able to tell us and give us better perspective, they might be, so they probably don't look at India, China, equity, they probably look at India basket, equity, debt. And if there is that passive money coming in, then maybe equity, it comes at the cost of equity. But for now, yes, nothing to worry about because the markets are doing a good job avoiding and not stressing about what the FIs do. A far cry from what our markets used to be a few years ago. In terms of stocks, Niraj has highlighted, of course, the broader market setup. Bank Nifty, you watch out for that one because yesterday's low becomes an important support on Bank Nifty. We did see a sharp up move on Bank Nifty in midday trade, and that's the graph in front of you. But eventually it turned quite volatile, closing the day at 49,291, 48,950. That was the intraday low made on Bank Nifty, is an important level of support you want to watch out for. PSU banks versus private sector banks, the debate continues. In terms of stocks, like I said, we've got a few that you want to track in early trade. Earnings season and elections are almost behind us. We are back to picking up counters on back of order wins, which usually react quite significantly. In terms of news development, Bajaj Finserv, watch out for this one. Bajaj Housing Finance board has approved an IPO. An IPO will include fresh issue of shares aggregating to up to 4,000 crores, and this was reported to the exchanges last evening, clearly indicating that this could be a big positive move up for Bajaj Finserv in today's day of trade. Apart from that, you have Hero MotoCorp. They've picked up an additional 2.2% stake in electric mobility startup Ether Energy for about 125 crores. So watch out for Hero MotoCorp. Wipro has backed a pretty large deal, $500 million by a leading US communication service provider. The contract is a significant one, 4,175 crores. So I think Wipro in terms of the IT names is one you want to track. You've also got Bajaj Finserv and Hero MotoCorp. Two of my railway names, RVNL and RITES, there've been a few order wins. Like we said yesterday at the event, it's every morning that you wake up to HAL and RVNL bagging orders, and this morning is no different. RVNL bags another big order for 495 crores. It's another significant one. The stock was up 5% yesterday. Further upside is what's expected. In fact, Niraj alluded to that the PSU rally could see some follow-up buying today. And of course, when you have news like this, more than likely, at least this one's doing well.
Yeah, everybody is so negative and the stocks have just done so well, so interesting. You know, and by the way, Wipro viewers, remember, IT's had such a good move yesterday that Wipro assumed significance for more reasons than one.
But Neelkant Mishra and Madhukila both said that this is not what we're getting carried away with.
Yeah, that's true. By the way, if you're wondering what event or Neelkant, Madhu or the technical guys, I mean, we had a fantastic event yesterday at the NSC, and it'll be there on our social media handles, our website, and our channel will play out those interviews during the course of the day as well. You know, I wonder if just 2 or 3 names very quickly. One is Zomato. Now, I don't know if really the stock reacts or no, but a Blinkit warehouse near Hyderabad was raided and multiple violations were detected. Food Safety Department had conducted the inspection at this warehouse. If Zomato reacts, you should know why it is reacting. Petronet LNG could react because a Citi note today says that the PNGRB issued draft regulations seeking to bring LNG terminals under its purview. Usually something like this happens. The street doesn't take very kindly to it. Maybe, just maybe, the stocks react negatively, so watch out for that. And one of the dailies, pink dailies today, is carrying this news about how ZF Commercial promoters could sell up to 4 to 5% stake for about 1,500 crore rupees. Any kind of supply usually discourages movement on the stock on the upside and very often brings about downside. So watch out if ZF Commercial is reacting negatively today. Watch out for that one. And Samina, not too many brokerage notes today. I mean, the one that stood out for me was this Morgan Stanley on chemicals. So just want to highlight that before we go to our guests. They've downgraded the chemical sector. They've said that they will wait for an upgrade cycle to come in. Morgan Stanley on chemicals, that is. They will until the earnings upgrade cycle begins, they'll sit on the sidelines. Downgraded SRF to equal weight, target cut there. Downgraded RT to equal weight, target marginally increase there. And downgraded Tata Chemicals to underweight, target has been cut to 843 versus 904. My colleague Varsha will spell this out in greater detail, but watch out for some of the chemical stocks.
Yeah, and just a couple of stocks that have been moving up until now. In fact, you picked up Heritage Foods, which has, of course, seen an up move. We cannot rule out another good start for this counter on back of the political development. And ITC as well. The stock, of course, moved yesterday, but it wouldn't surprise me if you see some follow-up buying on the stock as they've approved the demerger of the hotel business. So,
by the way, sorry, something that missed my eye. Why ITC has announced that yesterday, DB Realty post-market hours has also demerged its hotel division. I don't know the numbers really. But
and even IPO coming from Bajaj Finance. So lots of corporate activity that will keep a lot of these stocks active in trade. But of course, the big talking point is the RBI policy meet. We have Vishy, who's standing by at the RBI headquarters to give us a sense of what to expect. Vishy, good morning. It doesn't seem like there's going to be much on the rate front, but I think all eyes on GDP, inflation, and of course, what is going to happen with all that money and the dividend payout.
That's right, Samina. Good morning to you too. The policy is most likely going to be a pretty much of a non-event. You know, the vast majority, or at least all the economists that were polled by Bloomberg are estimating that the RBI, the MPC, is going to maintain the repo rate at 6.5%. The stance as a withdrawal for accommodation. Honestly, I don't understand that stance yet. But for the last 8 policies, this has been the stance since February 2023, and the repo rate at 6.5%. So this will be the 9th one where that is likely to be repeated. But as you said, yes, the inflation and the growth forecast, those will be the main ones to watch out for. Remember that the RBI for FY24 was estimating a growth about 7.2%, but it's surprised on the upside at about 8.2% GDP growth. For FY25, we need to see if the RBI does change any of its expectations on the growth side. Similarly, on inflation, their expectation is for FY25 inflation is going to remain at about 4.5%. Whether that undergoes any changes, because that will determine what the future course of the monetary policy is going to look like, whether they intend to announce any rate cuts like what the market is widely expecting, that there will be likely a rate cut towards the end of this financial year. But we still need to hear that from the RBI governor. Remember that in the past multiple policies, he's been saying that the fight against inflation is not over, primarily because of food inflation. Now, even if you look at where inflation was, retail inflation was in April, you were pretty much within the MPC's range. However, the food inflation has surprised on the upside at 7.9%. It continues to remain sticky. So we need to see what exactly the RBI governor's commentary around food inflation is going to look like for the rest of the financial year, and where the RBI starts seeing some room for a rate cut going ahead.
Vishy, and we'll of course come to you once the policy statement is out as well. But thanks so much for bringing this initial update. As has become now a norm at NDTV Profit, one which we hope will continue, Lakshmi Iyer, CEO of Investments and Strategy at Kotak Alternate, is with us ahead of the policy. Lakshmi, great having you. Now I can say as always.
Thank you so much.
Great having you. So, what do you expect today?
Deja vu. looks like it. And I'm not the cast in movie Fukre, so I can't say a deja vu, but deja vu is what we are expecting. But I think a couple of things which are really worth mentioning is a lot of developments have happened globally. When we went into the April policy, we had a Swiss bank rate cut. But now we've had Bank of Sweden rate cuts. We've seen the ECB and Bank of Canada doing rate cuts after 5 and 4 years respectively. Not that it is going to change the apple cart quite dramatically, because none of these central bankers have indicated that it's going to be a series of rate cuts. So it's a one-off, testimony to the fact that inflation globally is also cooling off. But then you have Niagara Falls, US, which is clearly saying that... Yeah, absolutely. Well, the inflation data there is coming benign, but I don't think they are giving any indications to the market yet that they are in a mood to relent. So I think from that perspective, it will be slightly interesting to see what will be the narrative. Outer chances may be there, I think the Dil Mange More factor where people are saying thoda stance change hoga and stuff like that. But not 100% sure or not very high on confidence if that should happen.
But stance change hona chahiye. I mean, you've got monsoon where we have to watch out for what happens. Very high chance that we could see some populist measures coming back. You've got geopolitical risk, so there could be that slight outer chance where crude may once again start returning back to levels that may be uncomfortable, and the heat wave that's behind us. So all those factors are only going to mean that inflation could see an upside risk, you'd agree?
No, I'm with you totally. So, crude oil prices again, we keep tracking policy to policy. What has been the change? This time it's down actually 15%. But look at industrial metals, they're up 20%.
Yeah, commodities, you're right. Yeah, China might be coming back. So,
Absolutely. So, you look at every other aspect, sans crude oil, everything is actually, even soft commodities are up. So, you're absolutely right. And food inflation. So while the headline is okay, we don't really have to worry too much about it. But food prices are still...
And growth is great. I mean, I don't even see why we even talk about a rate cut. Even if the Fed moves, hypothetical, India doesn't have any reason to cut rates, because if you've got inflation that may slightly be uncomfortable, you're growing at 8%. What's your complaint? Where is all this extra money going to go into, right?
No, totally. That's why these would be outer chance, not base case assumptions. Base case assumption is still the
status quo.
Plain vanilla status quo, and it's okay to be boring sometimes. It's absolutely
no action
fine.
Is action.
No, we had a lot of action.
Yeah, that's true. Actually, we've had lots.
Yeah, and we need some time to recoup, and it's just weekend, so. I think just too much of action also drains you off. So I think this should be okay. Things are going good. One doesn't want to distort the apple cart too much. And of course, some of the thought processes I think may need articulation, including the dividend that RBI gave to government, for example. I think some of those things will probably hog center stage rather than policy action alone.
Yeah, the dividend for sure. But sorry, I just want to debate that point that you just earlier made, both of you. The RBI in its guidance for what inflation could look like, trajectory, right? Q2 is a meaningful dip that we are likely to see, right? As per the trajectory given. Sure, that could get altered a little bit because of this uptick, but not meaningfully, maybe because of the base effect too. Why not, if not now, but why not a rate cut in order to spur growth? We are at 6.5, it's good, not necessarily great.
So, if you look at on an absolute basis, the numbers are fantastic. If you look at it on a relative basis also, the numbers are brilliant. The country next to you is growing half of you. That's point number one. The largest economy is growing 1/4 of you. So I think with all of these put together, and we discussed this last time also, is rate cut a very necessary ingredient as of today to get pump priming the economy? The economy is already on a strong footing. So just trying to, populate your food is already reasonably palatable. Why would you want to spice it up further?
Being boring is good, like she said, right? Lakshmi, so while, of course, you said we'll be watching out for commentary, there'll be commentary on where that dividend came from. I'm not sure how that matters, but nevertheless, it's going to be important in terms of what they say. A lot of the commentary will be there that we'll watch out for, but will it have, it's great commentary, but will it have any impact on the debt market in terms of actionables, you think?
Very unlikely again, because again, if you go back to the previous policies, and this dates back to maybe even, the last 5 or 6 quarters or the bi-monthly policies, clearly telling you that the yield movements have been pretty much range bound. The only trigger today, if you ask me, that could probably lead to a downward movement of yields because is a slightly dovish talk, not necessarily the walk, because we've seen whatever has happened right now, and or a stance change, which again I would say 1 in 10 probability. But anything of that sort happens, you could see yields going down by maybe 7 to 8 basis points, but that's about it. Are we talking about a massive? That trigger can happen only if you get a kind of explicit guidance towards rate cuts, which the markets are anyways giving you, right? If you look at the interest rate swap markets, they are talking about nothing before October, for example, and a rate cut probably in calendar year 2025. If you look at Fed fund futures, the probability is just about 40 odd basis points.
70% apparently for a September rate cut. And it just keeps getting delayed.
Yeah, exactly.
When we spoke in December, I still remember around on Editor's Cut, we were also convinced that there was a rate cut coming. You walk on a buy duration. It was almost like it was, we'd all made assumptions that didn't play out, and now we keep pushing it out.
But inflation is actually cooling off even in the US.
Is it?
Yeah, marginally, but definitely the trajectory is on the lower side. And but as I said, is it necessary and the only ingredient for getting into a rate cut? Probably not. So I think some of those factors, and as I said, you're wearing a policymaker's hat, you don't need to be having that temptation to give in at every macro data. So it's okay to elongate, and that weight makes the markets even more exciting breed to deal with, I would say.
So, Lakshmi, you reckon that Shaktikanta Das and the MPC will play by the template of not taking any action before the Fed moves, or given a chance and given an opportunity and given a condition, if inflation is lower and growth maybe stalls a little bit here and there, can they move even before the Fed?
I would say it's okay if they move in tandem. Moving together will be a better thing, because ultimately we have to also solve for the currency.
Yeah.
That's very important. We do have a significant war chest. I always say our Brahmastra is our forex reserves.
Yeah.
But why to kind of, let it go for things like these where the situation doesn't warrant? I always go back to basics. If the situations don't warrant,
sure.
We don't really need to be taking the lead position in this.
Yeah.
And things are going good. It's not that there is no credit growth. It's not that any of these things. If any deposit mobilizations, if they need to go up further, you require rates to be where they are, not really come down.
Also, Lakshmi, you said before we started this conversation, you've got a lot of global LPs. How do they view India paper right now? Is it attractive to them? And also, what happens to existing investors? We've seen yields move down over the last few months. After many years of course, testing debt market participants, have they taken profits off the table, or have they added more allocation to Indian paper?
Looks like they're adding more. And they may continue. So if you look at the entire calendar year last year, the net purchases by foreign investors was roughly around little under 60,000 crores. And just 5 months, June has just started, just 5 months into the year, they are net buyers by almost 50,000 crores, which is a big number. And looks like that trajectory will continue, because see, US yields are at 4.3% and Indian yields are close to about 7%. And if you adjust for the currency depreciation, which may not be as severe as you've seen in the past few years, I think we're still doing about a net 5.5.
And this money that's coming in is held to maturity for the next 3 to 5 years, or is it easy money that will keep coming and going as soon as you see the alpha generation?
This is predominantly the stickier money.
Okay, good.
Because you have the impending index inclusion as well.
Oh yes, JPM. We've talked about that too so much.
Yeah, just one. Actually, from my end, one question, final question really, and which is around what do you anticipate this, because we haven't had a chance to talk, I think, post the dividend coming in, right? So the dividend coming in, plus the JPM bond inclusion, so on and so forth. A few people laid the bet, and they are on the losing side, that we will see 6.75 before June 10th. I don't think that's happening, but I would love to know what your trajectory on the yields is like.
See, while I don't have claim over astrology, but I can still tell you that without getting into dates, are we headed towards a downward movement in interest rates? The answer still remains to be yes. Could we probably test, we're at 7.05 depending on which benchmark you look at. Could we see at least a 15-20 basis points easing over this whole quarter, which is the next 2 or 3 months? Well, the answer is a yes. We cannot deny the fact that this bazooka that RBI has given the government of India can aid in not only the deficit reduction but also priming some Capex growth. In what proportion, we have to wait for the details. And as I said, the entire central bank crew globally is pretty atal that in this policy maidan, they want to be victorious.
Okay. No, sorry, I didn't mean from a astrology perspective, but more from a perspective of when do you get, if somebody is waiting on the sidelines trying to get into into paper. Is this a good time, or maybe waiting for 2-3 months is a good time?
No, absolutely. I
Do it
think
now.
delayed gratification doesn't work right
Doesn't
now.
work, okay.
It's
And
okay to
timing
get
these
in.
markets is again a failed exercise. We've seen that in the last 2 years, right? Just one quick question, and going back to where you said you've seen foreign money come in. But the anticipation, don't you feel, was so much higher? The last 2 months has actually seen an outflow from debt markets. Do you feel that between now and the inclusion and what happens post that, maybe, just maybe, we were overestimating the inflows coming in from foreigners?
I don't think so, because even if you look at the month of May, as I said, June is still underway, the FPI buying in fixed income is still net positive. Equity still continues to be net negative.
Yes.
So, of course, the pace has receded a little bit because even they are keen to see how the political scenario would have unfolded. Right, wrong, we don't really know.
So what did your clients say after what happened on Monday, Tuesday?
They're
Still
happy.
constructive?
They're all happy. I mean, happiness is a very sweet quotient to have.
Yeah.
And why not? I mean, you are having a third tenure of the same government and 15 years. I think in fund management parlance, consistency for 15 years is brilliant.
Yeah.
Brilliant is an understatement. So you can't have, things any better. And I think markets have been rewarding it in the same
actually,
manner.
I want to get your view on it, because Niraj and me were discussing this. When an outsider looks at India, is it an India equity versus India debt, or is it India debt versus, say, Japan debt, or Europe debt, or Germany paper? What is the comparison?
The comparison is typically EMs, which is EM versus EM in the same asset class bucket.
So it's okay.
And
so
DM
it's not
versus
country
DM.
specific, it's asset.
That is correct.
Any quick one on the dollar rupee, if you have a view? I mean, it's been such a stable currency. This one is boring for sure.
No, as I said, the past 4 to 5 years, the pace of depreciation that we have seen looks very unlikely that that kind of magnitude may continue. So while the depreciation will still be the order of the day, the pace and the percentage will be much lower.
Well, Lakshmi, lovely talking to you. I dare say, when you're here the next time, we'll try and talk about the interest rate cut trajectory, if at all coming up or not.
Absolutely.
I'd love
Sounds
to
good.
wager some things, even though you are not, as you said, an astrologer. But lovely having your thoughts.
You know something, Niraj? All the low probability things are manifesting, so you never know.
Yeah, you're right, actually.
Today could be well such day, you never know.
I'm a journalist. I love to provoke.
And I'm an optimist also.
So optimist means a rate cut is what you're hoping for.
But
or
today
a
I'm a
quiet day.
pragmatist.
Achha, thanks. Thank you, Lakshmi. Such a
you.
good time having you here. But a quick break. We'll come back, gear you up for this morning. It's turning out to be quiet. At least that's what we are hoping for. But like Lakshmi said, you just don't know. We'll take a break. Stay tuned. We'll be right back. Implied Nifty indicating to a flat start. Welcome back. You're watching India Market Open. Implied Nifty is indicating to a 15 to 18 point gap up this morning, but a quick check of what the F&O data is, or the cues are pointing to this morning. Like we said, it's been a good run for the last 2 days. We've tried to recoup quite a few of our losses that we saw on Tuesday. That's the picture on the Nifty futures at a 78 point premium for June futures, with an increase in open interest is what we've got. On Bank Nifty, of course, the picture is different, where you've seen Bank Nifty trading at a premium, but there's a decline in open interest, indicating that there could be some upside caps coming in on Bank Nifty. In terms of the calls input data, remember all through April and May, we've seen 23,000 turn extremely active with maximum call OI built there. Of course, the picture did change over the last couple of weeks, where ranges were sort of disturbed, and 23,500, even 24,000 had turned active. But it seems like we're back to base and back to basics. 23,000 saw maximum call OI built up. That was, of course, followed by 23,200. So this is, of course, a good sign, because you are seeing a little more activity about levels of 23,000 in terms of resistance, or what traders would be hoping for in terms of the upside. You also had 22,800 quite active. That's largely at the money, because we did see a close at 22,800 odd in yesterday's trade. In terms of put activity, 22,500, that becomes an important level of support as well. Max put OI was seen at 22,500 and followed by 22,800. So that's really where the conjunction sits, on the 22,800 mark on the index. Well, in terms of the wicks, that saw a sharp decline as well post-event. So option premiums have also cooled off substantially. No surprises there. This is post-event and usual move in terms of what's expected. 11% or back to levels of 16.8. A lot more comfortable if you're a trader on the street. So that's what we have in terms of what we're gearing up for trade. It is going to be a range-bound session. Of course, the street will attempt inching every bit closer to 23,000, but that level for today at least doesn't seem likely. Well, we have with us Amit Goel, who's joining us with a quick word on the index, and then, of course, we'll go into top trades. Amit, I'll start with your word on the Nifty and Bank Nifty. It's been fairly significant, the move that we saw on Wednesday and Thursday, but it seems like there's a little bit of tiredness that's set in this morning.
Yeah, hi, good morning, Samina, and thank you for having me. This week has been quite momentous, if I may say so. We have had some very, very sharp, unexpected moves. In terms of a trader's language, it would be, outside the implied ranges. Of late, what we have seen is we have recovered most of the losses that we have had on the 4th of June, which was the election day result day. Now we are back into the channel in which Nifty has been going on for the last for the year to date, and I am fairly a bullish participant in this market, and I see that Nifty will try and inch up in the coming weeks as well. However, I do feel that the market is going to be a little range bound and will take a breather from all the action that it has faced in the week of this week. So any trader who would want to trade Nifty would probably be better off setting up something like a non-directional trade, a short strangle or an iron condor.
Elaborate on the strategy then to play Nifty, maybe for the June series?
Sure. Samina, as I'm a SEBI-registered RA and I trade Nifty in my own books, so due to regulatory constraints, I generally do not, advise on Nifty as a strategy, but I mean, it's a fairly obvious strategy here. One could look at setting up a short strangle or an iron condor at 23,500 and 22,000 as the range, keeping downside support at 22,000. I do have, however, a strategy on Bank Nifty.
You want to tell us Bank Nifty, because what we saw yesterday was a pretty big push on Bank Nifty in the first half of trade, but we cooled off by the time we closed shop. Yesterday's low becomes an important support today. What is the strategy to play Bank Nifty, the upside and the downside risk?
Again, Bank Nifty being the largest participant in the broad index will track what the index is doing, and I believe Bank Nifty is also back into the channel, and if I see the charts, it is right at the mean, which is around 49,100 levels. I do not see Bank Nifty getting into a tearaway rally or a sharp drop as such. We have kind of had enough for the day, enough for the week. I would say that. The strategy that I would like to deploy in Bank Nifty is primarily a volatility play. And it is suggested that we enter into this strategy once we are out of the once the RBI policy is announced and the press conference is done for the day, so that the expected movement in the price is done and dusted away with. Post the event announcement and the news conference, the strategy that I would like to set up would be a slightly bullish biased strategy, in which I am trying to take advantage of the differentials in volatilities across the 2 weeks, which is the 19th of June and the 26th of June, wherein we will sell one lot of 50,000 call for the 19th June, and we will buy a lot of 50,000 call again of the 26th of June. This is essentially called a long calendar spread. It's a fairly risk-adjusted trade. The max risk in a per lot basis is about 1,600 rupees with a margin of about 23,000. We will aim for a target of 1,000 rupees, which on 23,000, 24,000 works out to a very cool 4.5% yield. And we will keep a rupee stop loss of about 750. We could also have a price stop loss on Bank Nifty itself, keeping yesterday's low, as you said, as a stop loss, which would technically trigger an exit here. This structure, I have constructed this structure more from a volatility perspective, because the 19th June volatility is elevated compared to the 26th of June's volatility, and we are trying to take benefit of this differential. Over to you, Samina.
That's an arbitrage trade right there on Bank Nifty. You have a bearish call, I believe, on Asian Paints. Now, for obvious reasons, we've seen defensives do slightly better than risk on or beta in the last 2 days. What's the strategy on Asian Paints?
Samina, every day is a new day. We were risk off on Tuesday. We were risk on Monday, risk off on Tuesday, and again back in risk on a mode, following the last 2 sessions. So what I see, what I see in Asian Paints, it has been traveling in a channel since the month of March, and the broad range happens to be about 2,700 to 3,000 levels, with some bit of spikes on both the sides. We've had some, reallocation of money into the defensives like Asian Paints and other FMCG stocks, given that verdict on 4th of June, but that seems to have reversed, and we notice some bit of profit booking in counters like Asian Paint. Asian Paint has been on a structurally down move also on account of large players like Grasim entering into the paints business. I noticed that the futures open interest, the cumulative futures open interest, is up about 8%, with price being about down by 1.8%, giving an indication that there is some amount of short built up in this counter. With 3,000 call OI seeming to be a very, very strong resistance, I am suggesting that we take benefit of the elevated IV levels and set up a bearish to sideways short iron pounder, in which we will look to sell the 2960 call and the 2700 put. I'm selling a put a little further down the price chart so that I can define my bearishness on this structure. We will also look to buy the hedges at 3,000 call and 2660 put, one lot each of the June expiry. The margin required for this is about 50,000, and the max profit in this trade held to expiry would be about 3,000, with a rupee stop loss of about 1,000 here. We could also have a technical stop here if 2960, which is yesterday's high, is breached today. We will then remove the structure. At that level, I think the actual loss would be about less than 500 rupees here. So
right.
It's bearish to sideways kind of a view.
Right.
Here.
So playing the arbitrage opportunity on Bank Nifty and a bearish trade on Asian Paints. Thanks, Amit. Have a good weekend, and we'll see you soon. Now, with that, it's back to you, Niraj.
Well, that's the derivative picture. Now, before we move to the technicals and fundamental guests for the day today, let's listen into some of the top voices who spoke at NDTV Profit's Invest 2029 event. The view from Goldilocks Gautam Shah, MK Ventures Madhusudan Kela, and a bit later on, Neelkant Mishra of Axis.
I see a lot of underperforming sectors and stocks coming back.
Oh, okay.
So
if you were to initiate a trade, the trade would not be on the index, but it would be on stocks or maybe sectors. Is that a fair assumption?
See, it's easy to talk about when 50,000 on the Nifty, but please mind you, every 6 months the world is changing.
Yeah.
You can't look 1 year beyond. I mean, in our own lives, you don't know how unpredictable
No, and
it
we
is.
saw that. Monday, Tuesday, Wednesday. Three very different days.
Correct. So I don't think it's going to be about the Nifty. Also, if you look at the Nifty P, you are at 21. So there's no way we are expensive. And if I actually look at the charts, I believe it's going to be very sector specific and stock specific. And many underperformers like HDFC Bank, which have done nothing for the last 3 years and currently trade at an 18 PE, I feel will make a very serious comeback. Not a recommendation, just an observation. So I think there's going to be huge segment rotation from the mid caps and small caps, which were very richly valued and very overbought on the charts. I think the focus is now going to shift to the large caps.
Okay.
And Nifty might not do much, but then stock pickers market is there, and you can still make serious amount of money over the next 6 months.
I think markets going forward will become very selectively. So I can't say that you buy the entire PSU basket. I must admit and say that in some pockets the valuations are, in my humble opinion, unsustainable, because we've gone too far into the future and discounted earnings for a very long period of time. So the kind of investor I am, अपने को तो रुपए का 4 अठन्नी नहीं मिले, तब तक लेने का नहीं है, right? So I am not going to pay this kind of valuation to buy any story, right? But for instance, again, you please run the disclaimer. It's not a thing to buy. PSU banks, I am still very comfortable because they are still trading at 5-6 P multiple. If I take a 2-3 year view, their balance sheets have improved significantly. A lot of them have 18 to 20% ROE, and they're still trading at one-time book value. If I take a 2-3 year view, there could still be an opportunity. So I don't think it's a basket case of buying entirely PSU or selling. In fact, I feel really sad because a lot of retailers are buying this random. Right, कुछ भी लेने का है. Some of the PSU finance companies have become more expensive than HDFC Bank and Axis Bank. I can't figure out in my head that is why that is possible.
Well, so the message seems to be that the PSU rally, even if it is intact, it is very selective now. I think that's to be kept in mind. And it's true at any point of time, but especially after such a breakneck move has happened. But I tell you, PSUs were up and active yesterday. Let's talk about that and more with Vineet Bulinjkar and Kush Bora. Both of them join us on the show today to talk about how they see the last day of the market. Gentlemen, thanks so much for joining in. Really appreciate you taking the time out. Kush, I'll start off with you. Good morning. It was great having you at the event yesterday, of course. But how is the setup for today? Are you initiating any trades on the indices?
Hi, Niraj. First up, a very good morning to you and to Meet as well. And yes, indeed, what a great event it was, last evening. I hope you keep playing the snippets, all throughout the day and over the weekend as well. Let me answer, a couple of questions, together. One that you mentioned about, the index trade, and also something that Samina asked yesterday. And I don't think we answered that in, the session yesterday, which is everyone keeps talking about buy the dip, but, where do you buy the dip? So if you see, from the year, starting of this year, Nifty and Bank Nifty both have been in an upward sloping channel. And if you, if I could somehow just show you my chart, but, the lower band and the upper band of the channels have been respected so beautifully. Now, just to put those down in levels, it comes down to 22,200 on the downside and 23,300 on the upside. So if you get, a trade which is closer to 22,200 or let's say within the band of 22,500, I think you're perhaps better off going, long on the market. So that's where the buy on dips strategy really works. And that's the level that I'm watching for. Now, to answer the question, what do you do from now on? 23,300 is the upper end of the band. We're still some distance away, and the bias has, after the Tuesday aftermath, again turned positive. So I will go out and buy the Nifty here. Maybe the momentum and the ferocity, may not be the same, but I think the bias will remain positive. So for me, 22,600 will remain a stop loss, and I am gunning for 23,100 and 23,300 in the coming, let's say, week or 10 days time.
Okay. So, Kush, and within this setup, therefore, what are the recommendations that you're making this morning?
Sure. So, I think the PSU names will continue to do well. Yesterday, we gave out a call on SBI. It's not a call today, but, constructive, on the name. Specifically speaking, 2 calls for today. EMS Info. This stock, again has rebounded quite sharply. If you see, it's taken out the high that it made on Monday and Tuesday as well. So 474, 485 are the near-term targets. 448 is a good support zone, so that should be your stop loss. V-Guard, again, this is a stock that we've discussed time and again. There was a huge congestion around that 385 mark that is taken out and how. So I think, this momentum here also will continue. 410, 418 are the near-term targets. 388 is the stop loss.
We also have with us Vineet. Vineet, good morning. Thanks for joining in. Are you feeling a lot more confident this morning than you probably did on Tuesday morning?
Definitely. And, a lot of events have flown through. We've seen some topsy-turvy turns. I think now all the eyes rest on what will be the composition of the cabinet. So to that extent, we are a little more comfortable. And we've seen a tearaway rally, supporting that. So I think going ahead, today we are looking at whether the RBI will cut or not. It is my expectation that they will guide via liquidity rather than directly through interest rates. And the RBI has been more of a global player in terms of, the monetary policy, coinciding with what the international markets have been doing. And generally taking the cues from the Fed, not necessarily from the ECB or the Canadian Bank. So I think we can expect a bullish commentary, and I hope that markets will rally behind this. And given that we've already lined up, I think the next place would be infrastructure plays, because what we are expecting during the budget is that there would be a lot of action around big bang reforms and very, very large ticket size deals that go out. So, we like all the infrastructure plays, and IRB, Adani infrastructure, Adani roads, a lot of things around water would also be issued. So we like all these water companies. Wabag looks very good. So these are some of the picks that I'm going with in today.
Okay. And Vineet, just so by the nature of the picks that you've given and even otherwise, I'm just trying to think, let's say I'm just trying to do the exclusion theory here. Does IT go out of the window completely currently? The reason I also ask is because IT is in a bit of flavor since yesterday. There are some order wins, maybe some defensive bent. But for you, is IT out of the portfolio right now, or a very small part of the portfolio, or not really?
So actually, IT is in the trade part of the portfolio. So it's an opportunity trade. And because you're expecting interest rates to come off, I think the entire pack of, the IT and the VC-led companies will all do well. So I think Zomato, PB Fintech, Persistent Systems, Orin Pro Solutions, and Intellect Design. The guys who are into products and services, but more towards the VC-led. I think those are preferred plays compared to the traditional software service plays.
Okay, this will say. Actually, coming on this, Kush, sorry if I missed out from an IT recommendation from your end, but Vineet makes this interesting point that IT is a part of his trading portfolios. I've usually not heard Vineet Bulinchkar say this. So I'm taking this with utmost seriousness, and I'm trying to ask you because yesterday some of the stocks showed that little bit of spunk as well. Would you be tempted to trade any of them?
If I were to trade some of them, I'll have my select names that I'm looking at.
And which are those? That's the point.
Yeah, I'm looking at the KPIT Tech and an Endurance. I am not really gunning for, the HCL Tech and Persistent Systems of the world. However, that said, Persistent was one of our top picks for the longest time. And we do continue to monitor that, very closely. We are seeing some green shoots, but it's a little too early for me to say that, I'd go out and, put a lot of money, behind these names. Opposed to those, something like an Endurance Tech has done fantastically well. So I think, these are some of the, if not entirely offbeat, but slightly different names, differentiated names that I'm tracking. We do have an eye on IT, but not really entirely convinced. Also, one very important point that even, Neelkant mentioned yesterday, during the event was that the US is not out of the woods yet. And, I do keep reading these articles from some of the eminent writers, right? And they also have this belief that the US is not out of the woods yet. And if that is the case, then I'm not sure that, the pressure from the IT stocks in terms of a price action at least, will go away anytime soon. So while you could have these trading bouts, not entirely seeing a reversal on some of these IT names.
But you're fairly constructive and are of the opinion that the Nifty and Bank Nifty could be scaling new highs. Tell us when and tell us whether there is a trade, which means go long on the Nifty at these levels and probably go buy in Bank Nifty as well.
Well, the when is a very big question. And if I was a betting guy, I'd say perhaps in a week, perhaps 10 days. And I'll tell you why I say that. We mentioned about the upward sloping channel on the Nifty. There's a very similar upward sloping channel on the Bank Nifty, and again, beautifully, respected by the Nifty and the Bank Nifty for the most part of this year. If you let go of, let's say, what happened on Tuesday and perhaps a bit of Wednesday as well. Now, for the Bank Nifty, the top there comes at about 50,500, just a little over. So that is one data point that is giving me this confidence that we could again go out and test that higher level, perhaps extend that rally a little more and touch 51,000 as well. Also, the fact that I was listening to the the derivatives data that you were putting out, and also the FIs are still net short. What we are seeing in the last 2 days is them covering part of their short positions. The last time around, FIs were short 3 lakh contracts, and they came in to cover. Nifty ran up 1,000 points and then some more. So I think that short covering is still pending. If that comes in, let's say next week sometime, then you could be looking at at least testing or coming even closer to the all-time high levels on the Nifty and the Bank Nifty both.
Whew, all-time highs on the Nifty and Bank Nifty. A quick check on implied Nifty before we go into a break. We're gearing up for a Friday pre-open trade and all eyes on the policy. 25 points higher is what we have. We'll take a break. We'll come back and we'll continue our conversation with Kush and Vineet and get the stock ideas as well.
All right, back with India Market Open right here on NDTV Profit. And we're 2 minutes away from pre-open, but I think it's important to take stock of some key newsmakers in the session today. Not too many, by the way, but Mahima Vachirajani, my colleague, is here to talk about some of the stocks. And Mahima, is it demerged Borosil Scientific, which you're talking about the listing today, or is there something else as well?
Correct, Niraj. So I'm talking about Borosil Scientific Limited, which is going to get listed on the bourses today. Now, just a brief about the company. The company is an arm of Borosil Limited, and it is into manufacturing of laboratory equipment and pharmaceutical primary glass packaging. Now, for every 3 shares issued in Borosil Limited, Borosil Scientific Limited will be issued 4 shares. So, total number of shares issued for Borosil Scientific Limited will be around 8.6 crores. In terms of stock price and valuation, well, adjusted price post the ex demerger price is 97.33, and the valuation based on the FY24 earnings stands at around 2.5. The peers valuation, that is La Opala, which is its peer, SPE stands at around 11.5 currently. The upper band for the listing is around 145.99, which is a 50% upside, and lower band 14.6. Now, the demerger record date was 5th of December, and closing price on 4th of December was around 445.55. So, based on this, the cost of acquisition for Borosil Limited will be 238.4, which is 53.5% of the total cost of acquisition. And for Borosil Scientific Limited, it will be 211.15, which is around 46.5% of total cost of acquisition. So, these are the key details for Borosil Scientific Limited, which is going to get listed on the bourses today.
That's what you're watching out for, Borosil Scientific. That's going to be debuting on the exchanges in today's session. Well, Vineet, of course, you talked about IT with Niraj, but everything right now is available so much cheaper. And I'm talking about the PSU pack, case in point. Are you going out, or have you gone out with a shopping list and picked up some of these counters on Tuesday, Wednesday? And if not, would you still be having them on your radar at this stage?
So definitely some of the PSU banks are coming on radar. This is primarily due to the fact, that over the next few months, we'll see some rate cuts come through. If you see the US treasury rates are around 5%, and we are going to see some sharp cuts coming through on that. And that the money that is parked there, 5% is a very good deal, good yield for the US market. So the money that is parked there, we believe that could find its way into the Indian markets. And, we'll see some of the PSU banks like Bank of Baroda, Canara Bank, PNB do quite well. They're sufficiently large to attract the FI interest. And we expect these stocks to outperform currently the private banks, which have been on a tearaway run. So I think these are some of the stocks that I would recommend. They are relatively safe. The NPA levels are not that steep, and the growth trajectory is quite intact.
Okay. Now let's try and think through some of the other things. I mean, we've spoken about banks, PSUs, etc. Look at what Greed and Chris Wood of Jefferies has to say. I mean, he speaks about how a challenge before Prime Minister Modi, but the long and short of it is the lines, the key things that they're saying that foreign investors will view any significant correction as an opportunity to buy. We haven't had a significant correction. That's the point, with the DI rush being the way it is. A 4-5% dip is getting bought into. The risk of further corrections, according to him, remains the greatest in the mid-cap space. So that's the other point he's making. Temptation to tilt to portfolio towards consumption versus investment plays. So that's the point. And the weightings in ICICI, SBI, REC and Coal India are being reduced by 1% each in the long-only portfolio. And investment in Policy Bazaar, which is PB FinTech, introduced with a 4% weighting. Now, something that Vineet was recommending as well, that you probably like something like a PB FinTech or some others out there, a Zomato and a PB FinTech, etc. Vineet, yes, PB FinTech has also given, has created wealth from the lows, not as much as Zomato. And I'm not comparing the two. The models are completely different, even though they weren't in the same group per se. My question really is, what is the thesis behind PB FinTech? And what are the kind of gains that you see, let's say, over a 3 to 5 year period, if somebody is willing to hold on to some of these tech businesses for that long?
So it's a very simple thing. Digitization is a very large theme And increasingly, you are accessing PB Fintech's policy bazaar to see what are the, different products available there. And they're pretty, their business model is very pretty aggressive with a human touch, where they call you up and, they help you browse through all the thousands of listed policies which which are tailor-made to your requirements. So I think that is one of the trends that is going to play out. And increasingly, people want to reduce their costs, right? So I think more than going with a insurance agent, I believe that a PB fintech helps serve dual purposes of reducing cost as well as, doing the selection of the right product. So that trend will increasingly play out. Addition to this is the fact that, when you cut interest rates, a lot of money starts flowing into these VC-led funds. VCs become active again. And, you're cutting rates after a very, very long time. And once these rates come down, the industry starts growing up, the sentiment improves, and all these digital stocks start playing out. So my guess is that, getting a 25% kind of earnings growth on PB Fintech would not be surprising over the next 3 to 5 years, because they're just now tilting towards accelerated profits.
Right. Kush, you mentioned your top picks for the day, but anything in the banking universe, or even actually, we'll talk about banking in a minute, Biocon, BHEL and Exide. These are the top 3 stocks yesterday. What are you expecting on them this morning? Further upside is expected, or some profit taking cannot be ruled out?
Well, no, I think consolidation will happen. Perhaps the Friday effect will also kick in. But if I were to rank these, I think I like Exide from here on. I think from an investment perspective also the charts are pretty solid. So Exide is up there. Then is BHEL. We've seen a topping out kind of a formation there. That's played out. I think the stock will now attempt a revival and a move towards those 320 levels in months to come. And then comes Biocon, which isn't really, a pick, but for sure it's in momentum, it's in flavor. So I think that could continue to move higher. So I won't rule out some sort of profit booking today, but all the 3 names that you mentioned definitely have momentum going for them. And, that could continue perhaps sometime next week.
Okay. On Exide, amongst other things that has happened, I want to pull that stock because, it's been a rank wealth creator. I mean, from 450 odd went up, or rather from 350 odd went up to 450, came back a little bit, went up to 485, came back a little bit, currently at 534, up about 7% yesterday. Some news bit, and Kush, did you give a view on Exide? If you not, can I first take a view on Exide, technically?
Very bullish. The charts look strong, and medium, long term, short term, all 3 all 3 time frames looks very solid.
Okay, so Kush Boda believes on the charts it looks very solid. Now, fundamentally, just a point. Maybe there is connection, maybe there isn't, but apparently, leading Chinese battery companies with ties to Ford and Volkswagen, US lawmakers are saying, Republican lawmakers are saying they should be banned from shipping goods to the US. Now, Vineet, my question is this: even if this were true, and even if Chinese battery companies don't ship to the US, does it mean the business will come to Indian battery companies? Is it too much of kite flying really, or not quite?
Actually, I think there's too much of kite flying, primarily because of the fact that these guys have not really, established their supply lines and put in place the infrastructure. I'm yet to gauge how good their batteries are before, you actually go global with them. So to my mind, it's a premature expectation that, that entire thing will start flowing out here. I think it would take a little bit of more time.
Okay, well, a little bit of more time, viewers, so keep it in mind. Maybe there are other reasons, by the way, just letting it out. Sorry, Vineet, just rounding off that conversation, but are you constructive? Even if that is kite flying, are you constructive on an Exide and Amara Raja, or not quite?
The facilities are up. They're rolling out their mills, they're getting onto the treadmill, and it's only the point of acceleration which is not kicking off. Because remember one thing, that one of Modi's biggest thing is that in this era of Modi 3.0, EVs are going to get a lot of impetus. So the 2-wheeler batteries, the 3-wheelers, even the 4-wheelers are going to pick up. And Amaraja and Exide are very, very well placed to milk this trend.
Right. Well, that's of course the battery play, but we've got Harsh standing by as always to tell us this time what Morgan Stanley's view is on chemical stocks. Harsh, is it a good time to buy as per Morgan Stanley, or they seem to believe otherwise?
In fact, they seem to believe otherwise, Samina. So let me first start off. What they're suggesting is the sector is not completely out of the woods. They're saying that fiscal 25 should see Indian chemicals revert back to growth, but there is too much already being priced in. In fact, with regard to the cuts, just taking a step back, 50 to 60% of the cuts to the street's forward estimates were due to one, global destocking, which was worse than feared, customers pushing out product offtake, and material unwinding of pricing power. Now, the key here is going to be the volumes, whether the destocking trends are going to stop, get discontinued is really what will be in focus. And that will drive EBITDA growth all the way through FY27. So that's one thing that Morgan Stanley really has their eyes on, which is volumes. So currently, what are they doing? They're suggesting that one remains on sidelines until an earnings upgrade cycle starts to kick in. They are remaining cautious, especially on specialty chemicals. They prefer refiners, gas utilities, and select commodity chemicals. They've downgraded SRF 8% downside from here, Aarti equal weight around 3% downside from here, and Tata Chemicals at 13% downside from here.
Vineet, thanks Harsh for that. Those are a few downgrades coming in on chemicals. MS still not very constructive on the space. Vineet, what do you think? Aarti, SRF, do you have a view on either of these chemical names? Is it tide turning for them or just not yet?
So we met Aarti a few months back and they were pretty constructive on the rally. And for them, it was about 3-4 months ago that we met and they were quite optimistic that, going ahead, the trend would reverse. I think it is not really playing out as estimated. And for us, it's still a wait and watch kind of policy. Not going all the way in, but definitely Aarti, SRF, Deepak Fertilizers are some of the names that we are positive on. So if you really want to play chemicals, I would focus on pharmaceuticals. Sorry to say that. Piramal Pharma is one of the better plays in this space. Pharma chem, the lobby that is there. So I think Piramal Pharma is looking well tuned for a rally from here.
Okay. So in some sense, while Vineet is bullish on chemicals, he's wanting, instead of playing chemicals, he's saying, let's go and play through pharmaceuticals. And Morgan Stanley is saying, until the earnings upgrade cycle comes in, let's not go out and buy chemicals as well. And there is a school of thought which says that I don't want to buy the bottom. I'll rather buy when the trend changes, even if I buy it 5% or 10% higher, because then the swiftness of the gains will come in quicker. So I think that's one factor to watch out as well. By the way, as we speak, the pre-open rates have settled. From amongst stocks which were in news, I think DB Realty is certainly making a move, up about 4% at 198 or 199 now. 2 or 3 days on a trot now. This stock has had a really good move, and not surprised that with the news that has come in, which is that the hotel business is being demerged and some other details have come out, that stock is certainly flying off the charts here. Kush, last 2 or 3 days, DB has had a really good move. Would you book profits here if you were long, or would you stay long here?
Well, I would book profits because if you see, this is like a dead cat bounce. The stock's barely, able to hold on to the key, medium to long-term averages. And there is a very strong resistance around the 200 to 205 mark. So, I'm not even sure if anyone's holding this for the last few months, would even be in profits. Perhaps a lesser loss is where, you would consider and then exit. So for me, DB Realty at the moment is, a book profit from, at the current level.
They've got so many other names that are going to be in focus this morning. IT is not looking too bad again, actually, and that's interesting. And so is real estate. Vineet, are you buying realty stocks?
We like realty stocks a lot. And to my mind, the second line, the realty plays are looking very good. So, you could go with the Shobha. I think it's a relatively safe trade to take.
Right, stocks like Tata Chemicals, Aarti are already reacting to that Morgan Stanley report. If they needed any more reasons to sell off, they've got one this morning. AMI Organics, if you can quickly pull that up, there's some selling that might be coming in from a fund there too. The stock, they're not reacting just yet to that. But it looks like we're setting ourselves up for a flat morning. Before we go into trade, Kush, one top trade at 9:15. If we get an opportunity, what would it be?
So I'll go with something that Vineet also mentioned. VA Tech Wabag looks strong, strong volumes. I think 1120 and 1150 should be your levels to watch for, and 1050 is where you should place your stop loss.
VA Tech Wabag. Any short trades on chemicals, Kush?
I think a lot of names, but I think a UPL might not sustain the up move that it is seeing. So a UPL, I'm always on the watch out to go short on. 550 is my stop loss, and on the downside, you could be looking at a 525, 520 kind of a move as well. Maybe not today, but in the coming days.
Well, okay, Kush, thanks for that. And amidst all this news flow, Adani Ports has gotten an operation and maintenance contract for the container facility in Kolkata. That's interesting. So it just shows that business is business, and nothing can really, nothing should and can deviate things too much from that perspective. This is apparently the second contract, if I'm not wrong. The group is bagged in Kolkata as well, and their multi-state presence just continues to move up. On the ports business is what I mean. Okay, 13 seconds left for the markets to kickstart trade this Friday morning. The interesting piece will be whether some of those high-flying stocks for the last few days, do they continue to do that, or do they see some profit booking as the markets start off very, very flat? Very flat really for the large caps. I doubt the mid caps and the small caps will be doing something dramatically different. They could be marginally in the green. Banks in the red, in fact, and dragging the index lower. Marginally in the green as we expected. Small caps about 0.5%, so not bad going. Bring up the heat map and show you what's moving and what's not. Wipro is top draw. Adani Ports follows suit. So Wipro on the large order win is up about 2.5%, and Adani Ports and Tech Mahindra follows suit, by the way. So IT is now taken over. The first four gainers are IT names yet again, second day on a trot. In fact, even TCS is in the list. And then there is an Adani Port. So Adani Port is the only one that is wedged in between the gainers. There is ONGC marginally in the green. Almost even Stevens between the green and the red. Maybe a bit more red, to be honest. But still, IT holding fort. Banks aren't, because HDFC, SBI, etc. are seen the red. But the top losers, IndusInd, again a bank. Ultratech is down. JSW Steel is down, so commodity stocks seem to be taking a bit of a pullback. We don't have clear trends here as the market is in a bit of a lull, except for the fact that IT is building on. Now, Samina, the top 6 movers are all IT names. Second in a trot now. There's a bit of a reversal here.
Not a trend reversal though. Niraj, don't get ahead of ourselves. For now, not looking bad on IT. It could be defensive play. And of course, that anticipation that there could be a rate cut coming in from the US if the non-farm payroll data continues to weaken. Lots of other areas of the market. But before we go into that, a quick check on the broader market picture. Remember what we saw yesterday is while the Nifty gained, it was the mid-cap and the small-cap index that led the way up. This morning, they're underperforming the index to a little bit of an extent. Some profit taking in the broader market is what most people would expect. But of course, the small cap index is trading with a marginal gain yet this morning. In terms of stocks, a bunch of stocks to pick up on. Wipro, if I can pull that one up, it's part of the IT theme this morning. Got a pretty large order, and an order to the tune of 4,000 crores. That is significant to say the least for even a Wipro. The stock is up 3.5% in early minutes of trade. RVNL, this one of course reacts and has been reacting for the last few months now to order wins. Today is no different. RVNL trades the 2% gain in trade on back of a pretty significant order win. RITES as well had an order win, but we'll talk about that in a minute. Those stocks from the real estate railway pack are the big gainers winners in trade. Well, DB Realty, Niraj mentioned this before we got into trade this morning. It's been on a roll over the last 2 days. They are looking at demerging their hospitality business. On back of that, the stock is up 4% this morning. There could be a listing coming from the Bajaj stable, on back of which Bajaj Finserv is seeing a marginal uptick in trade. Well, on the sell side, Morgan Stanley's downgrade has meant that chemical stocks are having it rough another morning. SRF is down 1.5%. Aarti Industries is flat, but Tata Chemicals is taking it to its chin, down about 3% in trade. You had three big movers yesterday: Biocon, BHEL, and Excite. They were the top gainers. Biocon stays flat, and all these stocks, despite such a sharp up move yesterday, are not seeing heavy profit taking emerging just yet. Despite the broader market sentiment being muted, they're keeping in line with that, not selling off, not gaining, but that comes in as no surprise because these stocks did phenomenally well in trade yesterday. Along with that, you've got Petronet, LNG, and ZF Commercial. ZF Commercial, the promoter is looking to sell a little bit of stake there, so the counter is trading flat. Interglobe Aviation has had an upgrade from Kotak. The stock is up 0.8%. So that's what we have, Niraj. No runaway rally, no runaway losses. Stable as it gets, but IT, like you said, is the start today.
Well, 2 days on a trot now. These stocks have done well. For people who have missed out on doing this, Kush Bora, very quick thoughts here, and then we'll mark some other stocks. But is it, would you, I know you said you don't want to go for the HCL Text of the world, but they are moving. Wipro is moving, Tech Mahindra is moving. Would you go short there?
No, don't fight the trend. They're just reversing, as Samina said, it's perhaps a little too early, but at least they've got momentum on their side. So don't go short even after like a few minutes of opening. You aren't seeing any kind of PTSD pressure, at least on the likes of, let's say, Persistent. So I think this move could continue for some time, and then perhaps I'll go with what Vineet said, that this is perhaps a trading opportunity at best. So keep taking profits off the table fairly regularly, but no, not go short just yet.
Okay. By the way, speaking of, I mean, Mastech is up 14% on that Nvidia product usage. Remember, they're not offering an Nvidia product to people, or there's not a tie-up with Nvidia. At least, if I didn't get it right, and I was talking to my colleague Rucha on that. But let's wait and watch. Uno Minda is up another 7%. By the way, this stock is the other one that has really done well. And I wonder what the TDP impacted stocks are doing today. So yesterday they cooled off a little bit, but the likes of KCP, okay, up another 6%. Bring up Heritage Foods, 4%. Bring up Ramco Cements, and bring up Amara Raja. Well, Ramco is okay, quiet. It's a derivative stock, so it doesn't move as much per se. Anyways, Amara Raja is up another 2% as well. So pretty strong showing. Actually, the perfect guest to ask this. Before I ask Vineet Bulinchkar about Uno Minda, that is up 9%. Vineet, let me ask you. You track, amongst other things, cement so closely. I want to understand from you. Everybody's making this promise or this theory about how, with Chandrababu Naidu's party coming back, infrastructure development revival will happen in Andhra Pradesh, and therefore the Andhra-based cement companies, a KCP, it apparently is a plant close to the Dream City, or a Ramco, which has got large capacities in the state, or an NCC, which is a construction company, but might come back into flavor. Will these come back into flavor?
Definitely they will come back into flavor, because if you're building out a city, the infrastructure needs are going to be very, very humongous. And we are planning to build a city which is going to vie with Bangalore. So I guess that it's been a project dream of CBN since quite a while now, and definitely companies are going to benefit. But if I were to play a stock in the cement space, I would go with Sagar Cement, which is Hyderabad based, has a plant nearby also to the the planned proposed city, and that will do really, really well.
Okay, so you are saying Sagar Cement instead of a Ramco and a KCP, because Sagar also has a plant in Andhra Pradesh, Hyderabad, and close to these things. So Sagar is a buy. Do you have any targets as a brokerage house on Sagar Cement?
So Sagar is one of the most economical cement producer pan India, and when they grow, when the trend plays out in cement, they make some humongous kind of money. In fact, their partner, who's a silent partner for 19 years, has seen a 19% CAGR in value added over the time since they've been invested in this company. A lot of cement players actually go to Sagar Cement to, get advice on strategy, etc. And, given all these things, I think Sagar Cement will do very well. expecting a 40-50% upside over the next 18 months in this counter is not too far-fetched.
That we've talked to the management in the last couple of days. In fact, we caught up with Garden Reach yesterday, and those numbers have been phenomenal for the company. Margins have expanded, order book is healthy, execution is on a challenge, and the stock is up 8% this morning. They've emerged as the lowest bidder for a 500 crore order, and that's the impact of that is visible on the screen with a 7% uptick that we are seeing. Kush, technically, I know this is not in the F&O space, but 1390 on Garden Reach, constructive. Is it a buy or it's an avoid for now?
No, very much a buy. The bounce or rather the dip that came about, held on to the 20-day moving average, and then we're seeing this, smart rebound. I think, on the upside, the 1480 level is very much, on the cards. It could reach sooner than later. So you could have 1480 or 1500 as your target. If you haven't entered now, the risk reward will still be in your favor because the stop loss comes in at 1380, which is a support zone, and is now would have acted as a resistance but has crossed it. So 1340 being your stop loss, you could play for about 100 rupee up from here.
Okay. Gentlemen, I really appreciate you taking the time out and giving us your thoughts. Some interesting nuggets today from both of you. Really appreciate, and have a great weekend.
You too.
All right, that's the view from our technical and fundamental experts. What we need to do is hear out Axis Bank's chief economist, Neelkan Mishra, making a case for bringing down the FY25 fiscal deficit target to 4.9% in July. Listen in.
See, FY24 deficit, as you know, was brought down from 5.8 to 5.6. The same reasons would apply. The reasons why they saw better dividends from PSUs and all of that would apply in FY25 as well. And then you have the 0.4% of GDP worth of extra RBI dividend. Because RBI was supposed to give 85,000 crores in the budget, they gave 2.11 lakh crores. I think that when they present the budget in July, they may actually bring it down from 5.1 to 4.9. And to add to what we just discussed, the one of the reasons that India has garnered a premium is visibility. Right? So why is it that metal stocks trade at 10 times earnings and consumer stocks trade at 40, 50 times earnings? Because you have greater visibility on future earnings. So effectively, you have better visibility on 26, 27 earnings, so you are giving a multiple on that and discounting that.
Thanks for tuning into Talking Point. I'm Niraj Shah, and our guest today on a very interesting day because Venugopal Gare's views are wedged right between what's happened over the last 4 days and the RBI policy as it gets unveiled in a few minutes from now, 33 minutes from now. That's RBI Governor Shaktikanta Das entering and of course arriving in the RBI headquarters, and what he says, whether there is a change of stance or no, whether there is a commentary which is slightly more dovish or hawkish, we do not know. I think it will be very, very important to see all of this. Well, but let's get in our guest, Venugopal Gare. He's India Head Research and MD at Bernstein Johnson on the show. Venu, good having you. I'm guessing I can address you as Venu, or should it be Venugopal?
Yeah, that's right. No, Venu is fine.
Yeah, I just remembered it from last time, but I just wanted to clarify this. So, Venu, great having you. Thanks for taking the time out. You know, I read your note with interest, wherein you mentioned that some of the kite flying or news rumors that were floating around were a very low probability. You did not assign them too much of importance in the note, and it was prescient in that sense because we now have an NDA-led government or BJP-led NDA government at the helm. What I want to understand from you is, where are you on this argument of whether there will be policy continuity and even if there is policy continuity, what's the extent of the emphasis of some of the themes that were laid out in the past continue to get that and therefore driving investor attention?
Yeah, so that's right. See, the starting point of any analysis right now was to figure out who's going to be in power, right? And that's a call that we all had to take, even if it sort of gets tweaked over time. So we took that call that most of the coalition partners were pre-poll alliances, and hence the reason for NDA to remain intact, and that's the reason why we believe the majority was a real majority. Of course, it will always be give and take in terms of what discussions go on behind in terms of ministerial allocations and things. May not be too material given that it's eventually NDA which is going to be running, and probably PM Modi who is going to be in power right as soon as he swears in the next couple of days. So the reality is, if that is going to be the picture, I really don't think there is going to be any material change with ideologies and policies, right? So if the flavor of NDA over the last decade, not just the last decade, 1999 to 2004, as well was about productivity, about investments, about generating new sources of economic growth for India, I think that is going to remain as a driver in terms of how things will shape up. Now, interestingly, when we wrote that, it was on a day when things looked, pretty confusing for the market. But later on, when we were listening to PM Modi's speech as well in the night, and interestingly, the commentary was all about manufacturing, semiconductors. It was about green energy and mobility and stuff like that. So it was very clear that that's the direction in which things will remain as far as the script is concerned.
Okay. So, Venu, would just trying to understand, right? And I'm not. There's nobody to blame because I can imagine how difficult your job would have been the last 3-4 days, because you were working with different permutations and combinations almost every single day, Monday, Tuesday, Wednesday, right? I couldn't envy you at all. The question really is now, what has been the client feedback to your notes as you've given them about what is the India stance now? Because, I mean, maybe it is a lot of factors here, but we've seen some serious, nearly $3 billion worth of selling that has happened from the FIIs in the last 3 days alone. And it's not that FIs were lock, stock, barrel into India. This year, they've largely been flattish, right? So what has been the client feedback? And how do you think emerging market dedicated funds or otherwise, or even India-specific global clients turn back to India? Because as we learn, even the EM mandate, I mean, the FIs are largely underweight India per se.
Yeah, so Niraj, I think I do agree that it might appear as very tough for everyone the last couple of days, but at the end of the day, we all work on scenarios and we assign probabilities to scenarios. That's how we typically operate and take those calls on where things will be more realistic. But the reality is that this entire construct of continuity of power that we have got in a very different form at this juncture, and the potential implications of this with respect to policy tweaks, not about the next 3 months, but probably over the next couple of years, is something which is still bothering a lot of investors globally, because all the questions that I've got over the last couple of days has been more centered around stability. What could be the risk around that? And would there be a larger subsidy flavor to the budget and going forward? Or, would that, one of the things that you had also raised earlier was about potentially Capex getting cut. So, in fact, these are the range of questions we've been getting. It's not just about just international investors, it's across the board from all investors.
Okay. And you told me that when you heard the speech, etc., I mean, some of the themes that have been in focus. Sorry, I'm focusing a bit on elections right now, then we'll move on to the other aspects too, but because it is top front and center. You mentioned that some of the themes that you saw gave you probably the confidence that some of the things may continue as well. The argument, therefore, is on, the other question is on valuations, wherein I wonder if you as a house have reduced the premium that is attached to India vis-a-vis its own history or to relative to EMs, even by a notch, because of a coalition government versus a full-blown majority to a party. Has that happened or not really?
Yeah, so in fact, we did not change. So what it means is that we maintained our multiples intact with a broader theory that policies will not change. The broader approach to economy will not change. Things around fiscal consolidation will still remain as an important key mandate. So we didn't really feel there was a change with the reason for us to change the broader target multiple for India. Another underlying factor was eventually about taking a call on earnings growth. Part of the earnings growth for us over the next few years is also driven by a lot of cycles. So we had to potentially assume that a lot of these cycles continue in a very similar fashion, leading us to the kind of earnings growth that is built into the market. So this is the reason we haven't changed. Yes, the operating word coalition politics, of course, is going to be something which a lot of investors, including us, would watch over time, but this was too early to sort of tweak.
Got it. Okay. So if developments happen at that point of time, if there is a need to do it, you might do it, but otherwise there is no need to do it. Okay. Fair point. I hope I summarized that correctly, Venu.
That's right.
Okay. Now, the other aspect is that there is a particular kitty which is available for the government to spend on various things. The belief before the elections was that it will be largely towards the Capex theme, which has been so strong, and albeit from the RBI bonanza, some bit of it used for fiscal deficit, so on and so forth. Let's assume that they don't tinker too much with the fiscal deficit because this government has shown that resilience on the fisc path for sure. Therefore, out of the remaining, they have, if it was 100 rupees, the belief was that, let's say 100 rupees was going towards Capex. Some people have put forth the thought that could some of it, and we are building out a hypothesis here, but could some of it be diverted towards consumption, towards rural, and therefore will the Capex pie coming off a little bit impede the valuations that some of the Capex themes are trading at? It might still be a reasonably large spend, but not as large a spend that enables people to give sky-high valuations to some of the Capex themes. I mean, just for illustration, I mean, just so that my viewers understand, the ABB Siemens of the world ran through, right, and trading at astronomical valuations. Can that sustain, or could that come under question mark, Venu?
Okay, so interestingly, if you were to look at my theory around this entire Capex versus subsidies, as well as Capex on its own, is that, look, Capex growth firstly has already moderated. And that's not a bad sign. That's basically a reflection of how things will be in the next few years. If you look at the previous years of government budget, they were running at 25 to 30% Capex growth. For the interim budget that you saw as well, which came through, the broader target after looking at the rebasing of previous year was about 17% growth. Of course, numbers would change as the actual numbers come out, but 30 went to 17. And if we actually dissect further the entire Capex and look at it in terms of the important drivers for Capex, things like transportation, be it road, railways, and other aspects, they were not really growing even at 17. They were sub 10%. So what does it tell you? That the market actually looked at and said that there's nothing to worry, because the entire flavor of Capex is going to be shifting from government to private over time. And more importantly, it's going to shift just from transportation alone, where a lot of work is already done, towards power sector, which is primarily invested by also the private sector. Its government is not the only one which does the heavy lifting out there. So you don't really need too much budgetary allocations. And more importantly, industrial capex cycle is always something which happens with a lag to economic recovery, right? So that's something which you don't really need to worry about. It just comes through on its own. So if the capex flavor is going to change over time, government dependence is going to change over time. Firstly, there's no need to worry about the allocations going forward in any case. So that is a different topic altogether, right? That was the stance. Number two is I somehow feel that there is no need, to go around and give, sort of specific dole-outs and subsidies. I actually find it quite odd to even think about what might happen. So what are they going to do? They will put some income scheme saying, I'm going to put $20 billion to the poor. How does it help the economy? Those are just episodic 1-2 month schemes or whatever. It help you for a few months. It has zero economic impact long term. In fact, productivity wise, it's going to be very damaging. Ideologically, these kind of things are very bad for the economy. I don't think that ideology is going to change. While you could relook at certain things, especially around agriculture, for example, which may not necessarily be part of the budget. How do we make agriculture more viable for the farmers, less dependent on monsoons, which of course needs a lot of infrastructure investments as well. It's an area where if we invest, that makes it more sustainable. And remember, the backdrop is we're heading into decent monsoons. So, a lot of that pressure also sort of tends to reduce if your crop output growth is also high, right? So putting all this into picture, I'm not in the camp that it's going to be taken off capex, even if you have a slightly higher social flavored budget, but it is not going to be impacting your capex or a fiscal deficit number. You already mentioned RBI buffers and other things, which is anyways going to be supportive to fiscal deficit.
Got it. And in fact, your note suggests some bit of that, right? That even if some bit goes towards social schemes, in some sense, there might not be too much of a problem. So, Venu, I'm just repeating this so that I understand it's better and maybe my viewer too, that private capex in all probability will come to the fore, and are the beneficiaries of a private capex cycle or a cycle driven both by public and private capex different than what beneficiaries are of purely a government-driven capex cycle?
Yeah, so see, when end markets change, there are of course some common beneficiaries always, but the beneficiaries of course tweak and change. So for example, think of it this way: if the entire focus was only on railways, right, of course you would have railway-specific companies do well. The entire focus was on defense companies would do well. There's no overlap between a defense company and a railway company and vice versa. While if you're going to be focusing a lot more towards power, where we have deficits and we do foresee deficits increasing over time, then it's a power supply chain, power financiers. A lot of things basically change. Now, there are some common companies, which operate across these end markets. And there are very few of them. So, for example, Larsen & Toubro will be a common company which operates across end markets. Some of the generic MNCs, have some bit of a power flavor, but they do a lot of automation things which are related to some part of infrastructure as well. So they may not be like top of the charts, but not as deeply impacted because they have exposure to power as well. So the MNC names you mentioned, for example, putting valuations aside, of course, because those are obscenely high, but that's a different topic altogether. So yes, beneficiaries do get changed over time.
Okay. So that's one aspect. I'm just curious to understand, you guys have very large clients, but when material changes into allies happen this is the last question on elections. Yeah, lest you think that this is an election-focused conversation, it's not. But just one last question. Because allies get changed materially, right? There is a large state of Andhra Pradesh that is an ally and will be an important one. Bihar will be an ally and important one. Do clients try and ask you about what do you think about beneficiaries of something like this, of a large key ally, because it's a 5-year term, etc. And are there things like this? Because we've for example seen in the last few days some TDP linked names doing really well. I believe that Andhra focused cement names could do well. But I'm just trying to understand: do you get asked these things? Do you even try and venture into these things? And if so, what are your thoughts here?
Well, that's a fair question. These kind of thoughts come into everyone's minds, right? How to make quick returns on those kind of strategies. So the reality is people do ask. But the thinking always is medium to short term and not from a long term perspective, right? So, and I do believe that, sometimes these kind of trades do work, and especially Andhra, which is a state which is going to be, I think, progressively benefiting materially in the next few years because the new dispensation, which is TDP, is pretty much an investment-oriented and a pretty growth-focused party, as well as from point of view of how they've, been in the state in the past. So there will always be this rush to figure out who are the beneficiaries of, potential infrastructure spends around that state. And maybe that's not a wrong approach. Don't want to make specific names out here, but this is a part and parcel of how investors look at the thesis.
Got it. Okay, that's a lot of election conversation. What we'll do is we'll take a break and try and ask Venugopal Garre about some of the other thoughts. There is a policy in about 15 minutes, but beyond the policy as well, how does he look at the rest of the year? Stay tuned. We'll be right back. Back with Talking Point in conversation with Venugopal Garre of Bernstein, and we've discussed election impact at length. We've, in fact, remember viewers, spoke about some of the contents of the notes that he had written, he and his colleagues had written all through the last 3 days as well, but it was great to hear from him in person the intricacies. Now, Venu, beyond this, what are the more important factors for market? Would you look at earnings growth? Everybody does, but is that the defining factor, or do you think what global policy makers do and thereby what RBI follows will be the more impactful factor, or is it something else?
So I think the most important factor out here is ensuring that the government, sort of gets into place. People are going to also look at ministries and figure out what kind of who are the ministers, even though I had originally felt that was not relevant. And I think that's something which people are going to focus on. And more importantly, remember, nobody's talking about it at this juncture. There was supposed to be a 100-day agenda after elections. So I don't think that has been sort of shelved. You're probably going to be hearing that as well in the next couple of weeks, which is more of the economic agendas, both for the near term and for the next 5 years, which is more a vision for the next 5 years. And then you have the budget. So I think what's going to happen is all of this is going to be the most important driver for how investors and us would sort of look at the earnings growth trajectory and landscape and tweak that over time. Nothing is going to change for this year, of course. It's more about how one would look at probably 18 months or 24 months from now in terms of earnings trajectory. Global factors are always important, and for us, the linkage is more about what happens to commodities and crude, and if that's going to change anything materially. To some extent, how the rate cycles shape up would have an influence on how we would also probably, go ahead in terms of our thinking. But that's not like too material at this juncture as a market moving driver.
Okay. The policy may not do too much today, Venu, but could the policy be a driver, or because the Fed rate cuts are anticipated, as far as most reports go, only in 2025, that the policy becomes a non-event from a market's perspective for the better part of the calendar?
Yeah, I mean, look, fag end of the year, let's see how policies probably, pick up in terms of importance. You would also have the fiscal deficit sort of idea, borrowing calendar and things, even though I think there's nothing to worry about. Right? So, the interesting thing I would want to watch is how does RBI interpret GDP growth rate? That's the main thing to watch. Are they going to be excited about the 8% growth or look at the real reality that GDP growth or GVA has been moderating over the last 4 quarters to just 6.3%? So I want to basically see that interpretation because that would have a material impact on how things would be in terms of how they look at policy as well.
Yeah, that's true. That's true. No, and that's a very important aspect that you've kind of brought out as well. So Venu, let's assume that if you were to look at this GDP GVA number and then try and correlate it as to where is it that growth might sustain. Valuations is a separate argument. I'm just talking about growth and thereby earnings growth following suit. Where is it that you guys have the highest conviction of earnings growth over the course of the next 12 to 18 months?
See, the reality is the conviction is more in areas which are order driven. So we're very confident about the Capex side of things where things will be good. Manufacturing stories, even though they are more mid-capish driven, those will be decent. Autos have also got a decent earnings growth landscape, but it is moderating. But then I don't really see any negative surprises to what is being already expected in terms of moderation of growth. Financials will be relatively stable in our view. So these are probably the areas where we're generally okay with, the earnings growth landscape. So there are a lot of areas where there could be risks, and see, look, the risks are going to be more centered around how consumption shapes up, because that's an area where things have been a bit weak in the last couple of years. We also need to see how commodities move. Of course, that could have some influence in how growth rates sort of shape up in terms of earnings. So those are like external risks that we need to sort of measure. IT services is a bit tricky, honestly, even though we've already seen a pretty large downward revision in terms of growth rates and expectations over the years. So we are like scraping the bottom out there in terms of growth, but then there is no comfort or guarantee that you're going to see a major lift or an upgrade revision out there. So that's like that, again, a weaker area where we need to watch.
Right. Venu, hi, it's also Samina joining in. You've talked about the larger macro picture and the outlook on the markets, but let's talk stocks and sectors, right? Banks has been put out as a sector that may take the lead from here on. How do you feel about banks, and also what are your thoughts on PSU versus private? Where does your bias sit?
Okay, so my broader thinking process out here is financial sector has been lagging the market for a while, despite the fact that I think we are heading into a pretty decent credit growth cycle and a low credit risk cycle. Any credit risk that comes in, of course, will come in over time, but not right now. So it was primarily more about regulatory actions, concerns around interest rate trajectory and NIMs, which is what was playing on the entire thought process of how to look at the entire financial sector. To some degree, it underperformed broadly. So, my thinking is that with continuity, with policies, of course, assuming remains same, the entire earnings growth trajectory remaining same, GDP macro remaining healthy, putting all this into picture from a valuations construct, it does appear as one of those sectors which really needs to move up and generate returns for investors. So we are positive on the financial sector from that perspective. Now, the second iteration out here is PSU versus private. Typical conversation. See, our house view would be very different. When I say house view, is strategy would be very different from a sector view. I'll put sector view aside. I'll tell you my thought process. My thought process is, look, if I put broadly, a PSU and a private sector bank into a very similar pedestal, the usual challenge has been on PSUs has been more about credit risk. That's a historic issue that you used to have. And more importantly, the fact that private banks were in a broader space where you would gain share from being smaller and they would be gaining share from the PSUs. But, having said that, the reality is when you look at the broader cycle from a growth standpoint, if you're going to be heading into a corporate lending cycle, PSUs also have, a key benefit in terms of being able to drive growth because of that cycle. Because a lot of private sector banks basically were moving away from a lot of infrastructure lending or such kind of things into more consumer-oriented areas, right, where they have sort of been focusing on in the last few years. From one bank, it's now almost every private bank talking about that. So I would not really put the PSU banking space aside completely, right? So it's not like untouchable anymore. We will have to take specific bottom-up calls out there and consider them as a very important investment candidate. So I would leave it at that in terms of my approach towards the banking sector.
Also, Venu, one other space that we are suddenly seeing a return in terms of flavor of the street is consumption. With the kind of victory that the NDA has come with, there is an expectation that there could be some populist measures as well around the corner, and rural consumption may be a good space to hide in. Do you feel the same? Do you feel like even though numbers don't reflect it just yet, FMCG consumption could be a good space to start adding or allocating to at this juncture?
So you're right. There's a trading-oriented philosophy around that you're probably going to be seeing more social schemes and more transfers of wealth to rural. But remember, you also have another situation where monsoons should be okay, right? So this is all combining together a thought process that maybe you should play some of these consumption plays linked to rural. See, the approach could be very different. Firstly, I don't think these are sustainable trades, honestly, because I don't really believe there's going to be sustainable money transfers that's going to happen. Yes, over time, you can argue that in the next couple of years, you're going to be strengthening the mid to bottom end of the income pyramid, of course, through employment or through other schemes around SMEs and others. But the reality is that it's typical of any cycle. You see 1999 to 2004 and beyond as well. The reality is that most of consumption names, including consumer staples, started to see volume growth strengthen only after 2007-8, after a couple of years of strengthening of the economy. I don't think this era is going to be very different. You're going to be seeing natural and organic improvement in volume growth rates after a couple of years. So anything you do right now with respect to rural or thinking about entering into extremely costly consumer staple companies, which are already pricing in a recovery and already embedding a very high long-term growth rates, is just a trade than anything else. And I would probably argue the better way to look at is from time to time, look at discretionary. That is the future, in terms of how consumption sector is going to move. Discretionary is basically, you could be in durables or parts and parcels of autos or some discretionary areas. Long-term thinking, I think that is what one should be focusing on.
Hi, thank you, Venu. It's always good getting your perspective. That's the Bernstein view on Indian equities and sectors that they're constructive on. We'll hopefully catch you soon. In the meantime, the markets are doing okay, actually. 22,924, soon 23,000 could be hit on the index. We caught up with Neelkant Mishra of Axis Bank, who talks about the various challenges in the IT space. He spoke to us exclusively at the NDTV Profits Invest 2029. Listen into that and we'll come back and, of course, start off coverage on the RBI policy meet.
Fundamentally, there are two issues with the IT sector. So I don't expect a two-quarter turnaround, to give you a simple answer. The first is that there was a period of overinvestment that happened in the sector globally between 2021 and 22. Right? If you remember, all of us thought that only virtual meetings will happen and everything will be digital and app-based and all that. So what is happening now is that many of these companies, Indian companies, are benefiting from or are getting these large orders. So everyone is tracking the order inflows and sign-ups, and they are extrapolating into revenues. But what is happening is that within those companies, there are a lot of project cancellations. So the companies are saying, this is not necessary. And frankly, as the US economy slows down, so it is now starting to slow down, there are visible signs, I think the pain for this sector could actually intensify, is my view. Mm-hmm. The second factor is that they are starting to see more competition. So, with the rise of the global capability centers, as companies are becoming more and more comfortable with the position in India, they are becoming comfortable with the Indian infrastructure and a lot of other things, they are starting to shift to India. So they are poaching senior people, they are paying much better salaries, and in many cases the negotiation is becoming harder because those guys are sitting in India and negotiating with you. So I think both of these are not easy to handle issues, and the sector is still expensive. See, it's a very good sector to be part of, high cash flows, professionally managed, very clean accounting and all of that. but I think the P multiples are still too high for us to be of interest. And I don't think we are done with the cuts yet. So I think that there is another couple of quarters of cuts before things really bottom out.